Wale, good morning. Thanks for coming through this morning.
Thank you, Bosin. Good to be
it's
here
a very
again.
busy Monday morning.
Yeah, absolutely.
We understand. So we appreciate having you here always at this point in time. This is a very new thinking, as it were, since the Securities and Exchange Commission came up with these rules and guidelines last year. And we've just seen about 2 companies running this through. The first was a bond, about 75 billion from Flour Mills Nigeria PLC. Now, Oando is talking about doing this book building process via for an IPO for a new company. Take us through this book building. Let's get a lot of enlightenment, as it were, on how it works and how it benefits us here.
Thank you very much, Bosin. I think I need to make this clarification. Book building is not a new, it's not a new development in the market, really, because I remember the first book building was done in 2007, and that was for Guarantee Trust Bank GDR, the Global Depository Receipts, and it was very successful. But of course, it was a GDR. You know what GDRs are. You have equity indexed in it. So in a way, it's a quasi-equity instrument which you can convert back to the equities of GTB Bank. So I would say on that basis,
and listed on the London Stock
Exchange.
On the
Stock Exchange. So I would say on that basis, book building has been with us since 2007. And when the GTB book building was done, it was done simultaneously in 2 markets: the local market and the international market. The expectation then was that the international market will take most of the stocks, but little did they know that the appetite in the local market far outweighed the international market, and we had a very successful outing for GTB. It was oversubscribed. But let me say 1 or 2 things about the book building process. Since GTB in 2007, we've been having that process for a lot of the offers, particularly the bonds, not necessarily equities. All the state government bonds that have come into the market, a lot of them have been done substantially through the book building process. And there has been SEC rule on this over the time. There was just an amendment. I think Rule 70-something was just added recently. But that addition now includes this
explanations about
the qualification, eligibility to participate in book building. But honestly speaking, I don't think for the retail investors we need to look at the net worth of who is going to participate in the book building, and that it must have 300 million net worth, excluding autos and all that. You don't need that. You see, what the market is about is who can bring the money. Who can bring the money? And a lot of the book building processes that we've done have been limited to institutional investors, because most of the securities were, were bond issues. Were bond issues substantially.
You think book building is good for us in this environment?
Absolutely. If you understand what the process is about. Before now, what we've had was a situation where, you have the issuer who wants to raise money, then you have the underwriter who has said, if the market did not buy these securities, I will buy it. I'll put my money on the table for it. And that underwriting could be firm or it could be standby, in which case, if it is firm, the underwriters are saying, I put the money down upfront and I take the securities, and then I go and sell down at my own pace, on my own terms. The second option is on standby. You are the company that wants to raise the money, you go to the market, you try to raise the money. If the market did not take it fully, the underwriter would take the balance that the market did not take. That's what we've been having before book building. But what book building is saying now is that, look, we don't need to take the gamble. What we need to do is to open up the process. Let all the people who are interested in this stock, those who have appetite for it, let them bid. You see, before now, you will set your price and say, I'm selling at 30 naira. And then you allow the market to determine how much of it, it has appetite for. But book building is such that you don't set a price. You set a band. You can say between 10 naira and 50 naira. And then the book runners throw it into the market, and you'll be getting bids. Some may come at 10 naira, some will come at 15 naira. Mind you, for the man that is investing, he wants to buy at the lowest price possible. Meanwhile, the company that is raising money wants to buy at the lowest price possible. You understand? So that I can, moderate its cost on the fundraising side. Meanwhile, when that process is going on, all the bids will be taken together, and then the book bidding process will close. At that point, the book runner will look at everybody that has bidded and try to determine the average price that settles, and then you call that the settlement price. After you have determined the settlement price, the book runner and the issuer will now determine whether they want to give people more shares or they want to return their money, because it's likely that somebody may have bid at 50 naira and the price settles as 30 naira. So he has 20 naira that he has substantially overcommitted. And if he had paid upfront, you have to either refund the money or you tell all the bidders to say, look, the settlement price is lower than what you have quoted for, and then we give you shares in consideration for your excess payment.
Do you think this book building process will revive the much desired new share offers market, IPO to be more precise?
I think we need much more things to be done for the IPO market to come back. It's not just book building, because what book building does is a price discovery. Our challenge in the IPO market has not been a pricing issue. It's been a whole gamut of other issues that has made the investing public to be wary of the equities market. And mind you, if the secondary market is not corrected and is not made attractive, it will have a negative impact on the primary market, because what you buy in the primary market will eventually find its way into the secondary market. So let's fix the secondary market first.
In terms of what the SEC puts out there as amendments and rules, regulations guiding book building, it seems to be a lot in favor of retail investors.
Yeah, there's this tendency towards the move that let's protect retail investors. Let's protect retail investors. It's fine. I like retail investors to be protected. But over the last 30 to 40 years, that has been one of the major problems of the Nigerian capital market. You know, the excessive concentration on retail investors. Mind you, retail investors, they don't constitute a high percentage of the market. Probably I think at best, maybe they used to be close to 20%, but with the market meltdown, I'm sure it must have gone down to probably like 7% or 8% now. Let's say 10% for convenience. Now, the market we have is a market where you bring the shares into the market and all sorts of retail investors will apply. So probably you might have 1 million people who have applied for the offer, and out of those 1 million people, it is possible that 98% of them are retail investors, and the value of the offer that they are taking might be less than 5%. So you have a lot of processing challenges where the registrar cannot cope. But what I think will help in that regard is not really book building, is making sure that we can institutionalize, you know, a mutual fund system whereby all the retail investors can go through mutual funds instead of coming directly to the market. And it is that mutual fund that will make up one application and use it to bid during the book building process. That
favors folks like you.
No, not necessarily. Not necessarily. It favors the market. It favors the market because instead of the registrar processing 1 million applications, maybe at best might process just like 100 applications. And allotment process can be faster. You will not have what we had before, where people put down their money and in 6 months, 9 months, they've not been allocated their shares, particularly when we were doing the banking sector consolidation. You see a situation where CBN will also say, okay, we want to do CBN verification. And people have gone to the banks to borrow money to buy into the shares. 9 months down the line, share certificates are not available to them.
But this book building process benefits those of you who are book runners, like BGL, for example, because it allows you to do a lot more new thinking as against the previous historical experience of just packaging a prospectus, have all parties meetings, decide on the price, and that's what goes into the hard copies that goes to the investing public. So this gets you book runners to begin to think.
I think under the book building process, you will still have all those processes. Going to SEC, you know, packaging the documents and all that. Nothing will change in all those ones. The only thing that will change now is that you are not going to the market with one price. You are going to the market to allow the market to determine the price at which that instrument will be.
Would there be, let's get some practical things sorted out here. Will there be public announcements of this book running period?
Yeah, there will be, definitely.
Will there be circulation of offer documents and things like that?
Not necessarily. I think it's just be circulated to those who are eligible to participate in the offer. It's not going to be
on the street.
On the street, but based on the SEC rule, I think about 20% is supposed to be for folks on the streets. So it's possible that they will still have to do that and let folks know they can participate. But that's why I said the challenge in participation is all the 20% that you are giving to the retail investors. Are we going to continue to receive them en masse? In which case, we will still not have corrected whatever has been corrected before. I would have been more comfortable with a mutual fund process where, because the beauty of book building is that you have allotment process embedded in that book building, such that the registrar does not need to start compiling and allotting all this stuff. As a book runner or as a placement agent, I can get 10 orders. Then I submit that 10. Already.
And you're doing
I've already allotted those 10.
You've done allotment.
Yes, I already allotted it.
It's automatic.
Exactly. Because if I have maybe 2 billion to sell, I'm not likely to sell more than the 2 billion I've been allowed to sell.
And if you have 20 customers for that, you just do your allotment.
You just do the allotment,
and the price,
you share it, and then it will be the price at which each of them have bidded, and then you can submit their bids. It makes the whole process to be very simple.
So if you're doing even a billion shares within that period, you can just fix it. It's easy to so it makes the job of registrars
absolutely, and it makes the investors to conclude the process very quickly. It doesn't tie down money. You can do big bidding and do allotment same day.
Oh, so this is not a problem.
It solves a lot of problems. That's what I'm saying. It's a very good development for the market. But I'm just saying, we've been doing it for bond issues. Even all these state government bonds, each time we do bill building, we open for one day and we close by the next day. If I remember, in the case of Niger State bond, we opened in the morning and we closed in the afternoon. You know what? Before we opened that offer, we had book built everything.
Ooh.
Yeah, it was fully sold. But if you have a green shoe, chances are that if you excuse me, if you come to the market to raise like 20 billion naira, for instance, and there's a book building process, there's also an embedded option sometimes that says if they demand more, you can still allot maybe another 10% or 20% in addition to the size of the offer. That is what they call the green shoe.
We'll talk about the green shoe later. I'm wearing a black one. I haven't seen a green color shoe, but maybe one of these days we'll talk more about those.
This is a financial green
market terminologies. But Oando, I'm sure you're familiar with Oando and what the company has done in the market. This is a company who prides itself as an energy trading company, and the talk is that as an indigenous company in the same basket, as it were, whether rightly or wrongly, with Total, Mobil, the foreign multinationals, and now doing extensively in the upstream sector, which is called oil exploration. Now wants to spin off its marketing, which is going to the filling stations, selling diesel, kerosene, engine oil, and things like that, away from the group itself, which will concentrate in oil production. This book building IPO process, you think, is a good thing that Oando's folks are thinking, Wale Tinubu is thinking about separating the upstream from the downstream operations and all of that, and bringing them separately to the market?
I think it's a good development. Let's look at it historically. What has happened is that about 2 years ago, Oando said to do this, hiving off and selling down 49% of Oando marketing. That's the one they are taking out of the Oando group so that they can, be a separate company on their own. But at that time, there was a price that Oando had in mind to sell those shares. Unfortunately, the market was dipping, such that the price that was set at the time eventually became higher than the price of the Oando group as listed on the stock exchange. You can see the irony of it. Probably maybe Oando group hypothetically was trading at 30 naira, and you have set this Oando trading, which is just a subset of the Oando group, and you have set it as, say, let's say 15 naira for convenience of analysis.
Like USCN and USM property.
Exactly, and you now see the price of Oando on the market going down, so that at the time, that subset is now being valued higher than the entire group itself. So advisors told them at that time that this is not sustainable. The market is not going to accept this. And that offer was slowed down on the basis of that. Now that the market is a little stable, what delayed the offer about 2 years ago was the pricing issue. And they were smart. I think Oando is very smart now to say, okay, let pricing not be the issue at this time. we go by way of bull bidding. Let the market determine the price at which we will sell this subsidiary now, instead of us fixing the price. And you will see what's going to happen in the market. And I think they have set a very wide band, very, very wide.
making you smile.
And I think that's intentional. No, making investors to smile.
No, you are smiling because it benefits you book runners. Because
no, it makes it convenient for everybody. Oando, it will be convenient for them, although they might not get the kind of price they are looking for. Because if you set your price, the market will determine the demand. If you set the quantity, the market will determine the price.
But
so
at least
they have set the quantity now, and now allowing the market to determine the price. I think that's a very brilliant.
You think this is a very good offer for this market? It's the month of March. Is everybody looking at this?
I don't want to be too categorical.
Okay.
Because it's going to be taken as an investor advisory to go and buy Oando marketing. But let me put this. Let me put it this way. As far as Oando marketing is concerned, they are going to be operating in the downstream sector. And for downstream sector, we know from the budget that was approved for this year that there's no provision for subsidy of petroleum products. So clearly, the regulation of that sector is going to happen. But I suppose that because of election, they are still going to continue to carry it. But after election, it's going to happen. And when that happens, oil marketing companies will be major beneficiaries of this development. And I think that's where the Oando attraction will come in.
I'll try to hold on to that alphabet I have in my mouth, but it's something like B.
What's that?
No, we're talking about book building and buying and things like that. Okay. But you wouldn't want to give any investment advisory here.
No. I've said that it's going to be a major beneficiary of the regulation, especially in the downstream this year.
So it's a buy.
It's a good buy.
It's a buy. Yeah. Oh, thank you.
Wale,
thank you very much.